before I sold my gold, I'd need to see positive real interest rates. I'd need to see the interest on the U.S. 10-year Treasury maybe 150 or 200 basis points higher than the rate of deterioration of the purchasing power. Imagine what a 12.5% U.S. 10-year would look like to the economy. Imagine first mortgage rates at 14. Imagine the prime rate at 12 or 12.5. The probability that that's going to occur in the next 5 years, that we're going to have a balanced budget, that we are going to solve the entitlements problem, which would eliminate the need for quantitative easing, and that we're going to have a positive interest rate above the rate of inflation, the probability of that is nil. The insurance product, that's worked for centuries with regards to that is gold.
According to Rick Rule, gold's pullback from $5,500 to $4,400 is a gift from God, not a reason to panic, as negative real interest rates, a $2.5 trillion deficit, and $120 trillion in unfunded liabilities make a sustained bull market inevitable. He also warns that after the U.S. seized $300 billion in Russian assets, no nation should trust storing gold or treasuries on American soil.
Not too long ago now, January of this year, 2026, when the silver price was in melt-up phase, really, truly melt-up phase, increasing in price exponentially, and I decided as a consequence of that to sell mine. The amount of hate that I received let me know immediately I was doing the right thing, first of all. But it's interesting that all the people, they were falling all over themselves to buy silver at 85 and 95 and 100, calling me a moron for selling it, and they don't seem to want to buy it anymore. Why is that? These are the types of people, Dunnigan, who, if they were in a store that announced a store-wide sale, would leave the store without buying any goods. Truly perplexing behavior. I'm delighted that this price weakness across the board is happening concurrently with my conference next week. It would be very difficult for me to stand on the podium in a melt-up situation where I was saying to my audience, you've come to the right place to get information. But the circumstance with regards to high-quality junior stocks is that in 6 months, many of them are off 40%. I think the micro news, if you can call it micro news, has been that with the administration having lost control of interest rates and interest rates rising, at least long-term interest rates rising, the U.S. dollar has strengthened, which has weakened the quotes in anything denominated in U.S. dollars, including gold. I welcome that as an opportunity. I believe that the circumstances in place for the conditions precedent for a gold bull market are very much in place. What's changed is that as a consequence of higher nominal interest rates, the gold quote and gold stocks have fallen. Given that I continue, Dunnigan, to believe that the next 10 years will be very difficult years in terms of the purchasing power of the U.S. dollar, I'm looking to acquire more gold. So the circumstance that confronts us now is a gift from God. Regardless of how you feel about Russia's action in the Ukraine, there is no disputing the fact that the United States government stole $300 billion worth of Russian assets in the face of U.S. treasuries. If the United States government has decided that they will steal your assets if they don't agree with your policies, why would anybody either buy U.S. treasuries or store gold and silver in the U.S.? That makes absolutely no sense. If you dial this thing back 7 or 8 years when the Germans asked to repatriate their gold, and the United States said yes over time. What? Yes over time? If I had an account with Miles Franklin, with Dunnigan Kaiser, I call it so I'd like my gold, and you said yes over time, I would not be a happy camper. So yes, those sovereign assets are going to be repatriated. And yes, over time, demand for U.S. treasuries by non-American state actors is going to decline because the U.S. government has given those actors no choice but to disintermediate out of U.S. dollars and also to look for storage options where their wealth isn't under the control of the U.S. legislature. They've left the foreigners, by the way, no second chance. The second question is whether, for reasons other than national sovereignty, you need to own gold and silver. And I think here the answer is yes, too. When you asked me a couple of years ago, Donegan, what would cause me to sell my gold, I said to you that gold had served investors well during periods of time when they were concerned about the maintenance of their purchasing power in the U.S. dollar, and also concerned about real interest rates. So let's look at that. What would cause me to sell my gold today as an American citizen? Well, first of all, you need to balance the budget. The budget is now, current budget, $2.5 trillion in deficit. And there would have to be some political accord around beginning to repay the debt, which now stands at $39 trillion on its way to $40 trillion. The second test would be that there would need to be some way for me to understand how the $120 trillion in unfunded entitlement liabilities could be addressed. People glaze over with a number that large, $120 trillion. Medicare, Medicaid, military pension, Social Security Trust Fund, those kinds of things. The net present value, not according to some cranky old libertarian, Rick Rule, but rather, according to the Office of Management Budget, the net present value of unfunded liabilities, depending on the discount rate that you use, is $120 trillion. So that would need to be addressed before I might sell my gold.
Can you bring us up to date on your current view of that outlook, and whether there's other characters other than copper you want to drag into that discussion? That's fine.
Well, this will be interesting for you as a bullion dealer, because silver might be one. People look at the fact that the silver price has advanced from $18 or $20 to a high of 100 and something, and that now settled back off. But the truth is, the silver price doesn't impact silver supply very much. New mines, first of all, the biggest sources of silver in the market are recycling and byproduct from, as an example, copper mining. To the extent that copper, lead, and zinc production fall as a consequence of underinvestment, byproduct silver production falls too. It's important that people understand the second and third order impacts of that. A different thing to focus on, Donegan, and you and I have talked about this before, is even copper deposits that we have discovered are having a difficult time going into production for various reasons. One example might be the Resolution deposit in the state of Arizona in the United States, allegedly a politically secure destination. This deposit is, by any stretch of the imagination, a world-class deposit, well over 1 billion tons of ore, grading 1.5%. in a world where the average copper mine around the world produces at 0.4%. So 3 times the average grade worldwide. And it's got a spectacular location. Central Arizona, flanked by copper mines. Good place to have a copper mine, right? A highway across it, rail across it, road, power, water, a town nearby it that copper miners live in. So you have labor. And this damn deposit has been in permitting for 28 years. 28 years. That's just one challenge. A different challenge is that building these copper mines is extremely capital intensive. At Metals Week in London, the end of last year, there was a paper presented that said that the 10 largest copper producers in the world have to spend $250 billion in the next 10 years to maintain their current level of copper production. That's very telling for several reasons. The first is they don't have $250 billion. They have to go get it. The second thing is that those costs, the cost to build a new copper mine, are inflating at between 8 and 10% compounded per year. So this $250 billion becomes $370 or $380 billion in 5 years. The third thing is that $250 billion investment maintains copper production at current levels, but copper's in a deficit. It doesn't overcome the deficit. And finally, it doesn't take into account that depending on who you listen to, copper demand is growing at between 1.5% and 4.5% a year. In fact, if current projections, conservative projections of copper demand stay intact, we will mine more copper between the period 2026 and 2050 than have been produced during the recorded history of humankind. In other words, we will mine more, or we will use more copper between 2026 and 2050 than we have used since the beginning of time up to 2026. And we don't have that much copper. We can find it, we can build it, but we needed to have started 20 years ago. It's important to note that even in the United States, where we are enjoying the benefit of world-class infrastructure and world-class basins, where we are enjoying relative abundance as a consequence of our shale production, it's important to note that at $60 or $65 a barrel, with current levels of interest rate and current levels of taxation, that oil is only marginally economic. It's important to note, too, that as much as 85% of our Tier 1 locations, figured at $60 or $65 oil, have already been drilled. Canada has more undrilled inventory. So we either need advances in technology, or we need higher prices, which skate more locations into the grade A locations, or we are going to begin to experience some shortages. It's important, Donegan, that your audience understands that these shale wells have very high rates of decline. They produce as much as 80% of their net present value in the first 2 years of production. And as a consequence, deferral of sustaining capital investments becomes increasingly important in shale basins, where if you don't drill makeup wells, and you don't recomplete existing wells, that your decline rates are precipitous. People need to understand that what happens in oil markets in 30 days or 60 days has almost no relationship on what happens in oil markets in 2 or 3 years. Investing in companies with long-lived reserves that have been maintaining their sustaining capital investments so that they can maintain production and hence their dividends, as an example, are, from my point of view, absolutely no-brainer investment choices when one is considering 2029 and 2030, which, by the way, as you know, Donegan, will be here much sooner than you suspect. I think the oil price goes lower before it goes higher. I think that is so because $90, $100, $110 oil destroyed demands in some countries, poor countries, not so much in the West, but in places like Sri Lanka and Bangladesh and Bolivia. And we'll have to work through that demand destruction in the face of renewed supplies. This will be feasting time. Make no mistake, feasting time. The global industry, primarily state actors, have underinvested in sustaining capital investments now to the tune of between $1 billion and $2 billion a day for some years, and they continue that. The need for sustaining capital has been exacerbated. Nobody was making sustaining capital investments in the Gulf for the last 4 months. And in fact, much of the existing capital was destroyed by war, so that needs to be replaced. All of this suggests that people who can get through the current malaise in energy markets, for people who look 2 years forward, 3 years forward, can make a lot of money. The kind of money that the people who listened to our advice in October of last year made. That's the way resources work. Copper, different story in the near term. I think that the period of high oil prices that we went through will have the consequence of acting like a tax, and all taxes are bad. Diversions of cash from the broad economy into the energy sector certainly help the energy sector, but they didn't do the broad economy any favors at all. So it wouldn't surprise me to see the balance of 2026 as being depressed times in terms of the global economy, which is to say that copper demand will probably be muted for the balance of the year. Also, higher interest rates make maintaining inventories of copper, particularly for speculators in places like China, more expensive. So I think you'll see some dishoarding of copper, and I think you'll see weaker than normal demand, which suggests to me that the copper quote may go down. Looking longer term, have no fear. The copper price doesn't go higher. It goes much higher. We have underinvested in copper for 30 years.